and prices. Introduction, that financial rates and prices, interest rate, exchange rate, prices, bond prices, and commodity prices are highly sensitive to uncertainty. Any change in underlying economic, financial, or operational conditions lead to risk and volatility. Measuring risk management, therefore, requires a clear understanding of the factors influencing financial rates and prices. The process of financial risk management comprises strategic that enable an organization to manage the risk associated with financial markets. Risk management is a dynamic process that should involve with an organization and its business. It involves and impact many parts of an organization, including treasury, sales, marketing, legal tax, commodity, and corporate finance. The risk management process involves both internal and external analysis. The first part of the process involves identifying and prioritizing the financial risk facing an organizations and understanding their relevance. It may be necessary to examine the organization and its products, managements, customer, suppliers, competitors, pricing, industry trends, balance sheet structure, and position in the industry. It is also necessary to consider stakeholders and their objectives and tolerance of risk. Once a clear understanding of the risk emerges, appropriate strategies can be implemented in conjunction with risk management policy. For example, it might be possible to change where and how business is done, thereby reducing the organization's exposure and risk. Alternatively, existing exposures may be managed with derivatives. Another strategy for managing risk is to accept all risk and the possibility of losses. There are three broad alternatives for managing risk. First, do not do nothing and actively or passively by default accept all risk. Second, hedge a portion of exposures by determining which exposures can and should be hedged. Third, hedge all exposures possible. Measurement and reporting of risk provided decision makers with information to execute decision and monitor outcomes both before and after strategies are taken to mitigate them. Since the risk management process is ongoing, reporting and feedback can be used to refine the system by modifying or improving strategies. An active decision making process is an important component of risk management. Decisions about potential loss and risk reduction provide a forum for discussions of important issues and the varying perspectives of stakeholders. Factors that impact financial rates and prices. Financial rates and prices are affected by a number of factors. It is essential to understand the factors that impact markets because Those factors in turn impact the potential risk of an organization's. Another factor is interest rates as a key risk factor, meaning interest rates represent the time value of money and influence nearly all financial instruments. Factors affecting interest rates, which are the factors: monetary policy, repo rates, CRR and SLR, cash reserve ratio, and statutory liquidity ratio. These ratios are maintained by RBI, Reserve Bank of India. Inflation expectations, economic growth, government borrowings, credit risk premium, liquidity conditions, impact on risk and prices. Inverse relationship between interest rates and bond prices create interest rate risk, affects loan pricing, bank margins, and asset liability mismatch. Interest rates are a key component in many market prices and an important economic barometer. They are comprised of the real rate plus a component for expected inflation. Since inflation reduces the purchasing power of a lender's assets, the greater the term to maturity, the greater the uncertainty. Interest rates are also reflective of supply and demand for funds and credit risk. Interest rates are particularly important to companies and governments because they are the key ingredients in the cost of capital. What said? Key ingredients in the cost of capital. Hmm? Most companies and governments require debt financing for expansions and capital projects. When interest rates increases, the impact can be significant on borrowers. Interest rates also affects prices in other financial markets, so their impact is far reaching. Other components to the interest rate may include a risk premium to reflect the credit worthiness of a borrower. For example, the threat of political or sovereign risk can cause interest rate to rise sometimes substantially as investors demand conditions, monetary policy, and the stance of the central bank. Foreign investors demand for debt security, foreign exchange market activity, levels of sovereign debts outstanding, financial and political stability. Expectations theory suggests forward interest rates are representative of expected future interest rates. As a result, the shape of the yield curve and the term structure of rates are reflective of the market's aggregate expectations. Liquidity theory suggests that investor will be choose longer term maturities if they are provided with additional yield that compensates them for lack of liquidity. As a result, liquidity theory supports that forward interest rates possesses a liquidity premium and an interest rate expectation components. Before 2 decades, what happens in cooperative banks? They are offering higher interest rate on investments, that is FD, fixed deposit kept by us in the banks for long-term durations for 5 years or more than 5 years. They are giving interest rate such as up to 9%. Okay. But nowadays, loan on different systems are available on 7%, 7.5%, 8%. So how can cooperative banks can give interest 9% on fixed deposit? Is it possible? No, it is not possible, because if it's happen, what will be done? People will uh, take loan from the banks on the interest rate 7% and will keep it as a investment, as a FD on 9%. Means what will happen? They will get 2% extra margin or profit between the loan and FD rate. Means 9 minus 7 equal to 2%. And this is without any efforts. Okay. And few smart people also do this. But nowadays, what's happened? Banks also offering uh, lower rates on long durations FD. If you are keeping FDs for short duration, then bank can offer extra interest rates. Bank also give extra interest rate on FDs to the senior citizens and women's customers. Okay, so keep in the mind. Preferred habitat hypothesis suggests that investor usually prefer one maturity horizon over another, can be convinced to change maturity horizons given an appropriate premium. This suggests that the shape of the yield curve depends on the policies of the market participants. Market segmentation theory suggests that different investors have different investment horizons that arise from the nature of their business or as a result of investment restrictions. This prevents them from dramatically changing maturity dates to take advantages of temporary opportunities. In interest rates, companies that have a long investment time horizon will therefore be less interested in taking advantage of opportunities at the short end of the curve. Few people kept their FDs in cooperative societies, that is Pata Sanstha and banks. But what happened if that society goes into liquidity? What will be happen? A administrator appointed by a cooperative department on that society, okay, to rule the all the transactions. And what will be happen? He will pay you the maturity amount of that FD, not with interest rate. He will pay you only your principal amount. Or few time what's happen? You have to sell out that FD on 50% rate. Means you kept that FD on 1 lakh. You should have to take only 50,000. Interest rate is a question of a long, long, long. Okay. If you are not getting the principal amount, what will be think by the people? They will think that जो भी मिल रहा है वो आज के दिन अच्छा है, So people are taking their amount on less rates. Factor that affects foreign exchange rates. Foreign exchange rates, meaning FX rates, determines the relative value of currencies in global markets. Factor affecting FX rates, foreign exchange, interest rate differentials, inflation differentials, balance of payments, capital flows, FII, FDI, then political and economic stability, market speculations, and risk impact leads to currency risk, affect exporters, importer, and MNCs, multinational companies, impact foreign investment returns. How? Let's see. Foreign exchange rates are determined by supply and demand for currencies. Supply and demand, in turn, are influenced by factors in the economy, foreign trade, and the activities of international investors, capital flows, given their size and mobility, are of great importance in determining exchange rates. Factors that influence the level of interest rates also influence changes rates among floating or market determined currencies. Currencies are very sensitive to changes or anticipated changes in interest rates and to sovereign risk factors. Some of the key drivers that affect exchange rates include, just a moment, are already mentioned here. Interest rate differentials, net of expected inflations, trading activities in other currencies, international capital and trade flows, international institutional investors sentiment, financial and political stability, monetary policy, and the central bank, domestic debts levels, debt to GDP ratio. GDP means gross domestic product of our country, economic fundamentals. In this way, foreign exchange rates factors affect on our economy also. One call is there. Just a moment. Foreign exchange rate is one of the major risks faced by the most of the corporates. There is always an element of risk inherent in their transactions, as the exposure to the exchange rate volatility in the market can have significant impact on their returns. The RBI and some of the major banks are trying their best to generate awareness among the market participants. It has been found that most corporates still do not make use of various risk management tools available to them. How? Can the clients reduce their foreign exchange risk? An attempt is made in this session to review the foreign exchange management of Indian exporters and importers and those clients who are exposed to currency risk other than Indian rupee. Present position at present, bearing a handful of big corporate treasuries, most of the clients are not giving due importance to their foreign exchange exposure and are not aware of the risk associated with it. If not managed properly, most of the clients are used to receiving paying their foreign currency in US dollar, even through more than 40% of our traders are not to the United States. In addition, they use cash markets for conversion of their foreign exchange requirements. This segment of the clients are not making use of forward rate agreements, cross currency options, and swaps. Reserve Bank of India and few of the foreign banks as well as private sector banks are trying to create an awareness and they would like clients to make use of these tools to enhance their profit as well as hedge their risk. However, public sector banks have to gear up their marketing and risk management expertise and start using and marketing these products to their clients. As these entities still constitute more than 60% of the market, this will not only help the clients but also will improve the liquidity of the product as well. Currency exposure and management. Among the many types of risk faced by corporates, FX risk is one of the prime risk. Here, the client has an opportunity to take this as a objective functions as managing the reward risk ratio will create value, not merely minimize the risk. In case of a foreign exchange risk, surprisingly, a better forecasting is a way of reducing risk, primarily because hedging efficiency is improved with a better forecast. It can also increase the demand for the clients, goods and services due to price competitiveness. In addition, it is always in advantages to hedge larger volume as it is cheaper and the benefit can be shared with the client's retail customers. Large clients can develop hedging skills or afford to pay for the services from an expert in the field. So, few experts always give you hint or convince you to buy the foreign exchange when rates are going down, down, down. They take it as an opportunity. Okay. And the person who can invest always take that offers. Diversification, flexibility, forecasting, and engineering are broad classifications for hedging. Diversification is the static form of risk management where you spread your bets across a set of activity that have low, even negative correlations with each other. Flexibility is a dynamic form of risk management that is not diversified at any point of time. In fact, you may have all of your resources committed to a single activity, but preserve the ability of quick switch between reserves. Foreign exchange exposures in the Indian market. Foreign exchange exposure resulting from the trade flows is the most common type of FX risk that companies paying for or selling things in a currency other than their own domestic currency face. This exposure is important as movement in foreign exchange rates can significantly affect the profit margin of the company. It is here, on account of ignorance and lack of expertise, that clients sometimes lose significant amounts. Few times what's happened, people keep foreign currency as only collections. Okay, just like when we are a child in our childish age, what happened? It was our best hobbies to collect coins, different types of coins, means oldest coins as well as newest coins. And few people also keeps hobbies to keep foreign currency also. Another area of exposure is borrowing in foreign currency due to cheaper rate in of interest compared of domestic currency. However, such borrowings expose a company to exchange rate risk both for interest payments and, more importantly, at the time of payment of principal amount borrowed. We have seen in the past the case of Asian companies that borrowed in US dollar and Japanese yen had to pay very high cost as they had not hedged their borrowings. Even in India, in the past, steep devaluation of Indian rupee hit the clients who had borrowed in US dollar and other hard currencies. Currency movement were very volatile in the past and hedging this exposure was must. Client had to have proper risk management system in place or had to pay dearly otherwise. Means someone has to pay extra if not managed properly. Managing foreign exchange risk. How can we manage the foreign exchange risk? Foreign exchange, a forward foreign exchange contract is a contract to buy a fixed amount of one currency for another at a fixed exchange rate on a defined date in the future. The price is determined by the spot FX, means foreign exchange rate, and the interest rate differentials between the two currencies at the time that the contract is booked. This is the most commonly used tools by exporters and importers. Forecasting the currency movement is the criteria to book forward exchange contract in case of both exporters and importers, and those who are borrowing in foreign currency hedge their risk by taking forward cover. The risk with this tool is in case of uncertainty of receivable, payable of foreign currency. The clients and exposed to exchange rate volatility and which can have significant profit and loss consequences. The same is in the case of adverse exchange rate moves, that is, when forecasting goes wrong. This tool requires a client to enjoy sufficient credit limits from banks and marketable lot, that is a minimum of dollar 2,50,000 for competitive rates. We have a very liquid forward market up to a period of 1 year. Beyond 1 year, the market is not liquid, and again the credit limit is the problem of developed the market, whereas developed FX markets up to 5 years forward as available. Currency options. A currency option is similar to a forward foreign exchange contract, but with major advantages that there is no obligation on the part of the buyer of the options to execute the FX contract if the market rate on the exercise date of the contract is more favorable than the contracted rate. This allows the buyer the benefit from favorable movements in the exchange rate and who yet are protected against unfavorable movements. In fact, many option strategies can be devised to make the risk exposure, market view, and risk appetite of an entity. However, that is beyond the scope of this article. Rupee currency options are yet to hit the Indian market. RBI has constituted a committee and a detailed report is available on their website. It is desirable that the rupee option hits the market soon. We must have to check RBI websites. What are the circulars are available there about finance, financial decisions, okay, the procedure of loans. RBI not providing loans to a single entity. Okay. RBI is providing loans only for national banks. Okay. And few cooperative banks as per the demand of our politicians or local ministry. Even though cross currency options were permitted way back in 1995, there are hardly few clients making use of the same. The reasons are lack of education, the constraints of marketable lots and price transparency, lack of risk management systems in the corporate treasury, and hesitance to pay upfront premium. It is desirable that once rupee options become a reality, the client will take advantages of the same. Currency swaps. A currency swap is an instrument that is used to use the currency exposure of an underlying assets or liability. In this, borrowers pays the proceeds of the loan in currency A to the swap bank and receives the equivalent amount in currency B at the spot rate. At maturity, the clients pay back the principal amount in currency A, which can be used to repay the underlying loan. In this swap, the borrower will receive market interest rates on the principal in currency A from bank and will pay market interest rates on the principal amount in the currency B to the bank. Meaning bank will be the mediator. In the last 3 to 5 years, currency swaps have become popular tools, and many of the big corporate and few public sector undertakings have started using this product. However, credit lines of longer maturity, marketable lots prevent small and medium clients from making use of these tools. There are few suggestions to customers. Suggestions to customers varies and depends on their appetite for market risk and strategy will differ accordingly. What is market view? Let's see. For the forecasting of currency rates, the dealers depends a lot on the market view and if the risk appetite of the client is reasonably good, it is be very useful and they can cover their exposure accordingly. Those clients who are not willing to take a market view have no relevance. Clients who would like to use the various FX tools mentioned in this session should establish credit lines. Options are more appropriate if no credit lines are available. Responsibility to shareholders. It is very much necessary to disclose this FX exposure to shareholders, and in case of a need, it is to be discussed with shareholders so that they are not surprised at a later stage. Timing is very crucial for taking advantages of market view. FX is very volatile. A day's delay in implementing the decision will cost heavily on the companies. Means you have to take very fast decisions to avoid loss. And that loss is not a less loss, it's a greater loss. Planning. What planning can be done for this? An hedging program in which implementation is done in stages over a period of time is advisable. Reviewing the same on a regular basis and to get out of this strategy if the view was wrong, even if the cost is more absolutely essential. 20% of the exposure should be hedged immediately with a plan to hedge the rest in further portions over the period of say 1 year. The exact timing can be flexible depending on rate forecasting and market views. It is advisable to cover some portion of FX risk when the rate movements goes adverse to the forecast rate and costing of the product. Stop loss concepts has to be invariably decided at the planning stage itself. It is our experience that clients are painfully aware of the need to reduce their FX exposure by the fact that rates have moved significantly against it. To wait until the rate comes to the desired level without any hedge in dangerous. It is wished that a market view and system should be in place to distinguish between the two. Education resources available to customers. The Association of Certified Treasury Managers, an affiliate of the Institute of Chartered Financial Analysis of India, means ICF, conducts a treasury management program which covers all aspects of FX management as well as risk management. Today, we have arranged a workshop on finance, but you not attended that workshop. The eminent personality, the guest was for only for you. We invited him only for you, but you have not taken the benefit of that lecture. Most of the students have given different types of reasons, but keep in mind that college is arranging these types of workshop only for you. ACI, the Global Association of Market Dealers and Traders, also conducts various examinations which gives adequate knowledge to treasury personnel. The Horses Association of India is affiliated to ACI. Then there is a Catalyst Consulting, a treasury training and consulting firm, and more information can be found at www.corporateacademy.com. You can check also other domains or websites for these types of factors impacting on commodity rates, foreign exchange, interest rate, capital risk, etc. In addition, corporate can attend 2-3 days program conducted by many professional organizations which cover the basic aspects of market and risk management. How much amount that pay for this workshop or programs? Minimum 50,000 to 5 lakhs amount only for 2 or 3 days workshop, and college always arrange you the workshop, but you are not taking benefit of that workshop. You must have to be serious about your education. Key drivers of exchange rate: when trade in goods and services with other countries, where the major determinants of exchange rate fluctuations, market participants monitor trade flow statistics closely for information about the currency future directions. Today, capital flows are also very important and are monitored closely. When other risk issues are considered equal, those currencies with higher short term real interest rates will be more attractive to international investors than lower interest rate currencies. Currencies that are more attractive to foreign investors are the beneficiary of capital mobility. The freedom of capital that permits an organization to invest and divest internationally also permits capital to seek a safe, opportunistic return. Some currencies are particularly attractive during times of financial turmoil. Safe haven currencies have at various times included the Swiss francs, the Canadian dollar, and the US dollar. Foreign exchange forward markets are tightly linked to interest market in freely traded currencies. Traders arbitrage between the forward currency market and the interest rate markets, ensuring interest rate parity. Theories of exchange rate determinations. Several theories have been advanced to explain how exchange rates are determined. Purchasing power parity, based in part on the law of one price, suggests that exchange rates are in equilibrium when the prices of goods and services, including mobility and other issues, in different countries are the same. If local prices increase more than prices in another country for the same product, the local currency would be expected to decline in value vice versa its foreign counterpart, presuming no change in the structural relationship between the countries. The balance of payment approach suggests that exchange rates result from the trade and capital transactions that in turn affect the balance of payments. The equilibrium exchange rate is reached when both internal and external pressures are in equilibrium. The monetary approach suggests that exchange rates are determined by the balance between the supply of and demand for money. When the money supply in one country increases compared with its trading partners, prices should be rise and the currency should depreciate. The asset approach suggests that currency holding by foreign investors are chosen based on factors such as real interest as compared with other countries. For commodity prices, meaning commodity price include oil, metal, energy, and agricultural products. Factor affecting commodity prices, demand supply imbalance, weather conditions, geopolitical tensions, global growth trends, inventory levels, US dollar movements, risk impact, create commodity price risk, influences inflation and production cost, impacts profitability of firm. Physically, commodity prices are influenced by supply and demand. Unlike financial assets, the value of commodities is also affected by attributes such as physical quality and location. Commodity supply is a function of production. Supply may be reduced if problem with production or delivery occur, such as crop failures or labor dispute in some commodities. Seasonal variations of supply and demand are usual and shortages are not uncommon. Demand for commodities may be affected if final consumers are able to obtain substitutes at a lower cost. There may also be major shifts in customer tastes over the long term. If there is supply or cost issues, commodity traders are sensitive to the inclination of certain commodity prices to vary according to the stages of the economic cycle. For example, base metal prices may rise late in the economic cycle as result of increased economic demand and expansion prices of these metals. Means what are the metals? Gold, silver, copper, brass, iron. All these are metals which is always used as a commodity products in the commodity market. Commodities are monitored as a form of leading indicator. Commodity prices may be affected by a number of factors, including expected levels of inflations, particularly for precious metals. Another is interest rates, exchange rates, depending on how prices are determined, general economic conditions, cost of production, and ability to deliver to buyers, availability of substitutes and shifts in taste and consumption patterns, whether particularly for agricultural commodities and energy, political stability, particularly for energy and precious metals. Generally, agricultural commodities are used in commodity market, which agriculture products are in dry mode and not perishable, because perishable things are not allowed. They must have a lifelong shell life. Okay, so the dry means gram, tur dal, pulses. All these are used in commodity markets, wheats and others. Conceptual approaches for risk. In general terms, risk is a part of an human efforts. Once we leave to go back home, we are exposed to risk of different levels and degrees. It is significant that some new risks are completely voluntary and some are created by us through the nature of activities. Market demand and supply dynamics. Excess demand, price increase and higher volatility. Excess supply, price decline. Sudden shocks, extreme volatility. These dynamics directly affects market risk. We already learned this demand and supply in economic subjects. Inflation and price volatility. Inflation reduces purchasing power, leads to higher interest rates, increases uncertainty in returns. Inflation uncertainty increase financial volatility. Economic and business cycles. Expansion phase, rising rates and asset prices. Recession phase, falling rates and prices. Cycle influence systematic risk. Operational and risk and a price impact, meaning operational risk arises from failure in system, people or process, which is related to our industry. Operation level means creating new products in our factory. Example, trading system failures, fraud, human errors, impact, sudden price distortions, loss of investor confidence, increased market volatility. 9. Market expectation and information flow. New announcements, corporate earnings, policy changes. Rapid information flow causes short-term price fluctuations. 10. Government policy and regulation, interest rate controls, tax policies, trade restrictions, capital controls. Policy changes significantly influence financial markets. 11. Global and geographical factors, wars and conflicts, pandemics, trade wars, financial crises. These increase systematic risk and volatility. 12. Interaction between risk and volatility. Risk refer to potential loss. Volatility measures degree of picture price fluctuations. Higher uncertainty, higher volatility. Volatility is a key input for value at risk VAR. Portfolio risk models, derivatives prices. 13. Importance of for risk measurement. Understanding price impacting factors helps in identifying risk drivers, forecasting market movements, designing hedging strategies, measuring portfolio risk. Conclusion. Financial rates and prices are influenced by economic, financial, operational, and geopolitical factors. This factor interacts dynamically, leading to volatility and uncertainty. A sound understanding of these influences is essential for effective risk and volatility measurement in modern financial markets. Thank you. Today's session is over.